A good investor tries to maximize gains and minimize losses. Sounds easy enough, right? But how exactly do you go about doing that? Well, a good investor starts by considering his or her financial goals, time horizon, tolerance for risk, and liquidity needs. And while no investment strategy is foolproof and all investing involves risk, there are some basic principles that every investor should be aware of. I'm research analyst Nick Antonucci, and on this episode of Planning Priorities, I'll provide 6 tips that can help you in becoming a better investor. First, take advantage of time and compounding to help your savings grow. Put simply, compounding occurs when earnings that are reinvested also begin to earn money. Your balance grows both as you continue to invest and as interest is earned on both principal and accumulated interest. This interest on interest magnifies returns over time. The longer your money is invested, the more you may benefit from compounding. Second, buy and hold, don't buy and forget. You should periodically review your investment portfolio to make sure it's still aligned with your investment goals and risk tolerance. Investment recommendations are generally based on a snapshot in time and the information available. The idea is to leave your allocation alone unless something changes in your personal circumstances or your financial situation. Economic conditions may also warrant a shift in strategy, such as an adjustment to your asset allocation or a rebalancing of your portfolio because your asset allocation can change on its own due to market fluctuations. Rebalancing involves selling some investments to buy others. Investors should keep in mind that selling investments in a taxable account could result in a tax liability. Third, diversification is one of the easiest strategies to use to mitigate risk, and it can help reduce the impact any one investment has on your overall portfolio. Diversification aims to smooth out risk in a portfolio, letting some investments neutralize the negative performance of others. You can diversify a portfolio in many ways, and it's often beneficial for you to use a combination of diversification tactics. You can spread your investment dollars across different sectors, company size, asset class, and tax status. At Henssler Financial, our 10-year rule, where money you need in the next 10 years should be in fixed investments, while money not needed in the next 10 years or longer should be in growth investments, is an allocation strategy that determines how much you invest in each type of investment. However, it's important to remember that diversification and asset allocation alone can't guarantee your profit or prevent loss in a declining market. Fourth, endure short-term pain for potential long-term gain. There's no denying it, the financial marketplace can be volatile. However, it's important to stay calm during periods of economic turmoil and stay focused on long-term investing goals. Knowing why you purchased a stock can help you impartially evaluate it regardless of what the overall market is doing. It is also important to know how an investment fits into your portfolio as a whole. A volatile market is an inappropriate time to turn your portfolio inside out. However, a long-term investor will see a market downturn as a sale on stocks. If you know you like a certain stock, a lower price may signal a buying opportunity, as you may get a bargain by buying when prices are down. Next, consider the liquidity of your investment choices. Liquidity refers to how quickly you can convert an investment into cash. Generally speaking, the sooner you'll need your money, the wiser it is to keep it in liquid investments that typically have less volatile price movements, such as CDs, savings accounts, short-term bonds, or money market accounts. In your plan, you likely know when your large expenditures will happen, like children going to college or when you plan to retire. Once you get within 10 years of a known expenditure, you should not have those assets exposed to the volatility of the equity markets. Ideally, by matching your investments with your expenses, you should be able to avoid selling your invested assets in a down market. And finally, invest consistently with dollar cost averaging. Dollar cost averaging is purchasing a fixed dollar amount at regularly scheduled intervals, regardless of fluctuating prices over a period of time. This should result in a lower average purchase price per share, assuming you continue to invest consistently even in down markets. However, Dollar cost averaging can't guarantee a profit or avoid a loss. When the market goes on one of its periodic roller coaster rides, it's hard for the average investor to not feel a little unhinged, especially when the market data is so easily accessible on your computer, smartphone, newspapers, magazines, radios, etc. If you feel you want to make changes to your portfolio, take them in gradual steps. While investing success can never be guaranteed, putting strategies in place can help you weather the market's volatility and can help you stay on track as you pursue your investment goals. If you have questions about staying focused on your long-term goals, the experts at Henssler Financial are here to help. I'm Nick Antonucci. Thanks for watching.